Are you looking at the ultimate 2026 tech pivot opportunity, or are you walking straight into a retail value trap? I mean, think about it for a second. MRA Holdings Inc., or MRA, is
Yeah.
currently sitting at this absolutely massive contradiction.
Yeah, it's honestly wild.
Right. Right now, it's flashing strong buy signals across the board. We've got intrinsic valuation models claiming the stock is like 60% undervalued. And yet, its own top executives are just dumping their shares.
Which is the kind of setup that really makes you question your own eyes.
Yeah.
You've got these incredibly bullish technicals that are actively fighting against some uh, deeply concerning fundamental realities right under the surface.
Exactly. And that is why we're here today. It's April 14th, 2026. And our mission for this deep dive is to cut through all the noise for you. We've got a massive stack of sources on the table today.
A really massive set.
Yeah, the FY 2025 financials, the latest technical charts, the insider trading logs, and the current Wall Street analyst consensus. Our goal is to extract exactly what matters so you understand what's actually happening behind the ticker.
Right, getting past the headlines.
Exactly. But before we get into the weeds, I need you to do something. If you want to be part of this community, you need to like this video, subscribe to our YouTube channel, and make sure to leave your feedback in the comments.
Yeah, it's super important.
It really is. It's practically a compulsory part of joining us on these deep dives. And, your feedback really does steer the ship. Okay,
Yeah.
let's unpack this.
Right. So to really understand the tensions surrounding MARA right now, we can't just start with opinions. We have to start with how the market is actively valuing it today.
Yeah.
Before we open the books, the price action tells a very specific story.
Right. Let's look at the surface level, because as of right now, MARA is trading at $10.36. And if you're just glancing at the short-term momentum, you might think the sky's the limit.
Oh, totally.
It just had an 8.6% rally. And if we zoom out slightly to the mid-February 2026 lows, the stock is up a massive 42.9%.
Which is, that's a substantial short-term recovery.
Yeah.
A 40+% gain in about 2 months is the exact kind of momentum that brings, day traders and swing traders out of the woodwork looking for a ride.
But wait, here's the context that makes this whole thing so tricky. Even with that 42.9% surge, you look at its 52-week range, and the stock has traded anywhere from a low of $6.66 all the way up to $23.45.
Right.
So at 1036, we're still lingering near the very bottom end of its annual history. It feels a bit like buying a house at the absolute bottom of a neighborhood's price range right after the owner did a quick, flashy cosmetic flip.
Yeah, the classic fresh paint job.
Exactly. You see the fresh paint, but the foundation might still be cracked. So I have to push back here. If it's rallied over 40% since February, why is it still stuck in the bottom half of its yearly range?
Well, the 40% rally is just the fresh paint, like you said.
Yeah.
The reason the house is still priced at the bottom of the neighborhood is because of the foundational damage the stock suffered late last year.
Okay.
The market has a really long memory. That massive drop from the $20 range wasn't just an accident. It was a severe repricing based on the financial realities we're about to dig into.
Right.
The recent bounce is a momentum play, yeah, but it hasn't erased Wall Street's underlying skepticism at all.
Okay, so if the math says one thing and the recent momentum says another, we need to, look under the hood. Where is the money actually coming from and where is it going?
Let's do it.
I'm looking at their fiscal year 2025 income statement, and I'm honestly just confused. On the top line, total revenue came in at $907.09 million.
Which is huge.
It's phenomenal. That's up 38.2% year over year.
It is huge growth. But keep reading down to the bottom line.
Yeah, that's the part that makes zero sense to me. Net income is a staggering negative $1.31 billion. I mean, how do you pull in almost $1 billion in revenue and somehow lose $1.3 billion?
Right, and that resulted in a basic earnings per share of negative $3.69.
Wow.
Which, missed the Q4 consensus by a mile and drove those massive sell-offs we talked about. But to understand why there's this massive disconnect between high revenue and a catastrophic net loss.
You have to look at crypto?
Exactly. You have to look at the specific asset they were traditionally mining, which is Bitcoin.
Wait, so the accounting rules punish them on paper when crypto is volatile?
Precisely. That net loss was heavily impacted by non-cash BTC valuation changes.
Oh, I see.
Yeah, when the value of the Bitcoin sitting on their balance sheet drops, accounting standards actually require them to record that as a loss, even if their day-to-day operations are, generating solid revenue.
Wow.
It's a paper loss, but it terrifies algorithms in institutional scanners.
Okay, but it's not all just paper losses, right? Because I'm looking at the balance sheet and they have $7.29 billion in total assets.
Which sounds great.
It sounds amazing until you see the $3.60 billion in total debt. That's a 103.5% debt to equity ratio.
Yeah, they owe more than the equity they hold.
Exactly. And their free cash flow for 2025 was negative $312.35 million. But I noticed an anomaly here. The December quarter suddenly spiked to a positive $508.23 million in cash flow.
Right.
So what does this all mean? Did they suddenly become wildly profitable right at the end of the year?
Not from their operations.
Yeah.
That sudden $508 million positive cash spike wasn't because their core business started printing money. It came from asset liquidations.
Wow.
Yeah, they were selling off their holdings to generate cash.
Okay, so to understand why they're suddenly liquidating massive amounts of assets to raise cash, we have to look at what the company is actually transitioning into. Because, this isn't just a simple crypto mining stock anymore.
Right. If we connect this to the bigger picture, MARA is executing a massive strategic pivot. They're actively moving away from traditional cryptocurrency mining to focus heavily on AI data centers and digital energy infrastructure.
Now, hold on. A server is a server, right? Don't they already have data centers for the crypto mining? Why is this pivot so unbelievably expensive?
It's a completely different beast.
Really?
Oh yeah, crypto mining uses very specific hardware ASIC miners that basically just need cheap power and a big fan to blow the hot air out of a warehouse.
Right. Pretty simple.
But AI data centers require incredibly expensive high-tier GPUs, massive liquid cooling infrastructure, specialized fiber optic networking, and, well, a completely different power load consistency.
Wow. Okay.
You can't just unplug a Bitcoin miner and plug in an AI server. You're practically rebuilding the infrastructure from scratch.
Which requires an unbelievable amount of capital.
Exactly.
And that explains the major catalyst we saw in late March. The sources show that MAR liquidated $1.1 billion in Bitcoin. They sold their core crypto assets, and they used it to buy back convertible debt at a discount.
Yeah, it's a drastic move. First, let's clarify convertible debt for a second. It's basically a loan the company took out, but the lender has the option to convert that loan into shares of stock later on.
Right.
By buying that debt back early at a discount, MRA is trying to clean up that 103.5% debt-to-equity ratio and, reduce their massive liability so they look healthier while trying to fund this AI pivot.
But they're also preventing those lenders from turning that debt into shares, which we'll come back to because that's super important.
Oh, absolutely.
But here's the part that I think is going to make you pause. While the company is liquidating $1 billion of its core asset to pay down debt, the people running the company are quietly cashing out.
Yeah, this is the part that gets people talking.
The insider trading logs are glaring. CEO Frederick Thiel and CFO Salman Khan have been regular sellers. On March 17, 2026, they dumped a combined 43,505 shares at $9.18.
Wow.
Yeah, over the last 90 days, insider selling has exceeded $2 million.
Which is the ultimate red flag for a lot of investors. I mean, you've got leadership steering the ship into an incredibly capital-intensive, highly speculative AI pivot requiring massive debt restructuring while simultaneously taking their own personal chips off the table.
It's like an entrepreneur who owns a prized, reliable, cash-flowing vintage car collection. Suddenly, they announce they're selling the entire collection to fund a highly speculative tech startup in a very crowded market.
Yeah, exactly.
But while they're asking outside investors to fund the startup, the founders themselves are quietly cashing out their own equity and walking out the back door. Doesn't consistent insider selling naturally spook retail traders? I mean, if the CEO with the internal data is selling at $9, why should I buy at 10?
It absolutely spooks retail, and it spooks institutional money, too. Now, to be fair, insider selling isn't always a death sentence.
Right. They have to pay taxes and stuff.
Exactly. Executives get paid in stock. Sometimes they just need liquidity to buy a house or pay their taxes. But the volume and the timing here, right in the middle of a billion-dollar asset liquidation and a total shift in business strategy, it creates a major crisis of confidence.
Yeah, that makes sense.
It makes outsiders wonder what management sees in the internal projections that we don't.
And you'd think Wall Street would be running away screaming, the insiders are selling, the debt is astronomically high, the operations are bleeding cash. But then you look at the analyst consensus, and the ratings tell a shockingly different story.
This is where the divergence between fundamental reality and Wall Street expectations becomes just a fascinating case study.
Listen to these ratings. Right now, 80% of analysts have a buy or strong buy rating on Merrow. 20% say hold, and absolutely 0%, not a single one, has a sell rating.
Zero sell ratings on a company with a negative $1.3 billion net income and a completely unproven AI pivot.
It's wild. And the price targets reflect that optimism, too. Compass Point has a high target of $30. The average target is $16.48.
Right.
Even the lowest analyst target is $8, which isn't that far off the current 1036 price. But there's a negative short-term signal hiding in the weeds here. Cantor Fitzgerald just stepped in on April 9th and lowered their target from $11 down to $10.
Which is essentially them downgrading the stock to match the current market reality.
Right. But then you contrast that downgrade with the intrinsic valuation models. These are the mathematical models that look at the company's assets and cash flows.
The raw math.
Yeah, the raw math. The model suggests the fair value of MRA is actually $24.14. That implies the stock might be roughly 60% undervalued right now.
60%, wow.
So I have to ask a pointed question here. If the math says the company's assets make it worth over $24 a share, why are major firms like Cantor Fitzgerald dragging their price targets down to $10? Are these intrinsic models just living in the past?
That's exactly the issue. Intrinsic valuation models are heavily backward-looking.
Okay.
The model sees $7.29 billion in total assets and a 38% jump in revenue, plugs it into a formula, and spits out a $24 share price.
Makes sense.
But human analysts at firms like Cantor Fitzgerald are forward-looking. They see the $3.6 billion in debt, they see the negative cash flow, and most importantly, they know that building out these new AI data centers is going to require billions more in cash.
Meaning they're going to have to find that money somewhere.
Exactly. And if they can't borrow it, they have to issue millions of new shares to raise capital.
Oh, right.
That dilutes the value of all the existing shares. The intrinsic model says, look at all these assets today. The analyst says, look at the massive share dilution coming down the pike tomorrow.
Okay, so the fundamentals are giving us entirely mixed messages. You've got massive revenue but massive losses, intrinsic undervaluation but downgrading analysts, a high-tech pivot but insider selling.
It's a mess.
It is a tangled mess. So since the fundamentals are so confusing, we need to strip away the opinions entirely. Let's look strictly at the momentum and the charts. What are traders actually doing with their money?
Yeah, technical analysis is your best tool when the fundamental narrative is this confusing.
Yeah.
It removes the emotion and just tracks the capital.
Let's start with the trend direction. Short-term indicators are flashing a strong buy, but the midterm averages remain bearish.
Which perfectly reflects the tension we've been discussing.
Right.
The recent 40% rally is driving the short-term buy signals, but the larger structural damage from last year is keeping that midterm outlook very, very heavy.
Let's get into the key indicators, and let's keep this simple.
Mm-hmm.
The RSI, the Relative Strength Index, is sitting at 55.89, which is basically neutral but leaning a little bullish.
Yep.
Then there's the MACD, which is at 0.058. The sources note a divergence here. It's a buy on the daily chart, but some models signal a sell on the 1-hour timeframes. Can you translate that?
Yeah, think of the MACD like the speedometer on a car. On the daily chart, the overall road trip looks like it's speeding up. The broader multi-day momentum is pushing higher. But if you look at the 1-hour chart, it shows the driver is currently tapping the brakes.
Ah, I see.
Day traders are taking their quick profits, even if the longer trend looks upward. It's a stock fighting with itself.
And you can really see that fight when you look at the moving averages.
Mm-hmm.
The 50-day simple moving average is sitting down at $8.54, which is acting as a support floor.
Right.
But the 200-day simple moving average is looming overhead at $13.47, acting as massive resistance.
Those moving averages are acting like a compressed spring trapped inside a shrinking box. Every time the price drops toward that 850 floor, traders buy it up.
Yep.
And every time it rises toward that 1350 ceiling, they sell it down.
Yeah.
But the space between those numbers is compressing. Eventually, that spring has to snap violently in one direction.
So if you're looking at the chart, let's define the exact zones. Immediate support is right below us in the 953 to 968 zone. If it breaks below that, the critical major trendline support is way down at $7.27.
Right.
On the upside, immediate resistance is right here at $10.50. If it breaks 1050, it could run to 1161 or potentially even gap way up to 1530.
What's fascinating here isn't just the price levels, but the order flow combined with the short interest. The data shows incredibly high volume buying right at that $9.18 level.
Yeah.
Institutional buyers clearly stepped in heavily there. But the real powder keg is the short interest. It is exceptionally high, sitting at 30.00% of the float. That is 113.18 million shares sold short.
30%. I mean, for a stock this size, that is massive.
It's massive, and the mechanics of a short squeeze are critical to understand here.
Mm.
When 30% of the stock is shorted, it means traders have borrowed 113 million shares and sold them, betting the price will fall so they can buy them back cheaper later.
Right.
But if MRA breaks that immediate resistance at 1050 and starts marching toward 1161, those short sellers start losing money fast.
And to stop the bleeding and exit their positions, they are forced to buy the stock back at the current market price.
Exactly. That forced buying drives the price up even faster, which forces more short sellers into the red, forcing them to buy, creating a cascading rocket effect.
Wow.
With 113 million shares short, MRA is a prime candidate for an explosive upward move if any positive news forces those shorts to cover.
Okay, we've laid out all the puzzle pieces. We've got the underlying financials, the insider selling context, the wildly expensive pivot to AI, and this incredibly explosive technical squeeze set up on the charts.
All of it.
Now it's time to debate the reality of MRA. Is this truly a 60% undervalued gem waiting to explode? Or is this the ultimate value trap for retail traders? Here's where it gets really interesting.
It really does, because you could build a logically sound, completely data-backed argument for both sides right now.
Let's start with the bull case, the best case recovery scenario. If you're bullish on MRA today, you believe that these massive infrastructure investments into AI data centers are finally going to decouple the stock from the unpredictable, wild volatility of Bitcoin.
Right.
By strategically liquidating that $1.1 billion in BTC to pay down convertible debt at a discount, they're actively strengthening the balance sheet and preventing those lenders from turning that debt into shares.
Which is huge.
Add in that 30% short interest, which acts as absolute rocket fuel. If management proves the AI pivot is actually working, the shorts get squeezed, the momentum takes over, and the stock rockets back toward that $24 intrinsic value.
That's the optimistic view.
Yeah.
But the bear case, the worst case continuation lower, is just as compelling.
Okay, let's hear it.
The bears look at that $3.6 billion debt load and the persistent negative cash flow from operations, and they just see heavy anchors dragging the ship down.
Right.
Yes, they paid down some debt with crypto, but building AI data centers requires billions more in capital expenditures. The bears believe the risk of massive equity dilution is practically guaranteed. They're going to have to print new shares to pay for those servers.
Makes sense.
And when you combine that severe dilution risk with continuous heavy insider selling from the CEO and CFO, it just destroys investor confidence.
Yeah.
The bears are asking, why hold the bag while management exits out the back door?
So, synthesizing all this, looking at the upside potential of a squeeze versus the downside risk of the fundamentals. Why do you think so many retail traders specifically get trapped in setups exactly like this one?
It comes back to that specific phrase you brought up earlier, 60% undervalued.
The label.
Exactly. Retail traders often run a basic stock screener, see an intrinsic value of $24, look at the current price of $10, and assume it's a guaranteed bargain. They get lured in by the label.
But they're missing the forward-looking part.
Precisely. They don't factor in the mechanics of the pivot. Transitioning from crypto mining to AI infrastructure isn't just flipping a switch. It takes years and billions of dollars.
Right.
To get that money, MRA will likely have to heavily dilute the stock. So yes, the physical assets might be undervalued today, but if the company doubles the number of shares in existence to pay for those new data centers, the value of your specific slice of the pie gets cut in half.
Oh, wow.
That's the trap. You buy for the value, but you get crushed by the dilution.
That brings this whole thing full circle. We really have two different time horizons to watch here. Synthesizing all of this, the short-term outlook on MRA is purely a momentum and short squeeze play.
Yeah, entirely.
You're watching that immediate $10.50 resistance level on the chart. If it breaks through that, the 30% short interest could easily ignite. But long term, this is the ultimate prove it story. Can management actually execute a massive multi-billion-dollar pivot into AI while carrying a mountain of debt and bleeding cash?
That's the divide. Short-term traders are playing the chart mechanics. Long-term investors are betting on management's ability to pull off a miracle transition without diluting the stock to zero.
Now, obviously, we have to state clearly that this discussion is purely an exploration of the source material, the financial data, and the market consensus. This is an analysis of the facts as they stand on April 14th, 2026, and is absolutely not financial advice.
Always do your own due diligence,
Yep.
especially with a stock showing this level of contradiction and volatility.
But before we let you go, I want to leave you with a profound, unresolved question to chew on. Something that wasn't explicitly stated in the analyst reports, but is hiding right there in plain sight in the data.
Ooh, I like this.
Think about the catalyst we discussed. MARA liquidated $1.1 billion of its core Bitcoin holdings today to pay down debt for an AI transition.
Right.
If a company that built its entire empire, its entire identity on mining crypto is willing to dump $1 billion of it right now, what does that quietly reveal about their internal belief in cryptocurrency's immediate future versus the AI boom?
Wow. It's a question that challenges the entire narrative of their past decade.
It really is. Are
Yeah.
they just balancing the books to survive, or are they getting out of crypto while they still can? Let us know what you think about that cliffhanger in the comments below. And remember, as we said at the top, please like this video and subscribe to the channel so you never miss a deep dive. Until next time, keep questioning the consensus.